With that, let's go over to Nigel for the World View.
Well, the US markets, they ended lower yet again. The Dow was down nearly around 500 points. Now, there are fears that interest rate hike is going to come about, but is the economy strong enough to take that interest rate hike? So on the back of that, we did see that those markets did sell off. Not just that, all the 30 Dow stocks ended in the red. You have 11 sectors in the S&P. All of them as well ended in the red. So it was red on the screen all over. And if we're looking at some of those losers, well, on the Dow, they were selling across the board. You had Amazon and Procter & Gamble, some of the biggest losers out there. Even other stocks, consumer stocks like Nike was under pressure, and Cisco as well. All of them ending with cuts of around 3 to around 4%. But the Nasdaq as well did sell off. And some of those tech majors, they did see big selling in yesterday's trading session. Facebook was under pressure. You had Amazon as well that was selling off. And Alphabet as well was under pressure in yesterday's trading session. So not looking good at all. And December hasn't really been a great month for the US markets, because all of them are sitting with cuts of around 6 to around 8%. And that's the sharpest decline we've had in the month of December for those US markets all the way since the Great Depression in 1931. So not a great start to December. But it's not just the US markets, even the European markets, they've been a little jittery. Data coming out of China as well as the Eurozone hasn't been that great. And now all eyes are on the Brexit vote that will take place in January, the middle of January. January 14th is that day. Yesterday, what spoiled the party was retail stocks were selling off. So ASOS did come out with a profit warning. They're saying that, in fact, the revenue guidance may not be met. The margins will be under pressure. And all the retailers did see selling from around 3 to around 5% yesterday. ASOS itself was down more than 30% in yesterday's trading session. So that's about the European markets. Coming back to the Asian markets, though, the Nikkei is under pressure. That's down close to around 1%. That's a factor of the yen as well. The yen has strengthened a tad bit. So all those markets are under pressure. The dollar index, though, that's come off a tad bit from the high of around 97.8 odd. The SGX Nifty is indicating a cut of around 30 points. Keep in mind, crude oil prices continue to fall. Brent crude prices at around $59 per barrel. Back to you.
Okay, we're going to take it from there. In fact, the fall in crude oil prices, the dramatic fall indicates a growth slowdown. And that's been the overarching theme for the last many days. Jeff Dennis, the independent emerging market commentator, joins us now on the phone line. Jeff, hi, good morning, and thank you for joining us on CNBC TV 18. I'm going to come to the theme, which is the growth slowdown in a bit. But before that, what are your own expectations from the Fed? Do you also believe that a 25 basis points hike is coming, but with the dovish tone?
Yes, I think that's right. I think it will be very hard now for the Fed not to raise rates this week. They've given a pretty clear signal they're going to do that. So I think if they backed away from the rate hike, it would mean that the markets would start to fear the panic, perhaps, that the Fed was very worried about the economy. Typically, the view I've always had is that the Fed doesn't react to the markets as such. It really only reacts to the markets when the markets damage the economy. And so I think you would expect to see them raise rates this week. But it could well be the last rate hike in the cycle, or if not the last one, very close to the last one. So I would expect a very dovish tone out of the Fed this week, despite the rate hike. And I think markets will like that when that comes through.
Well, yeah, nobody's told us it would be perhaps the last. There are still people expecting the dot chart to forecast 2 more rate hikes next year. But Jeff, good evening. Thank you very much for joining us. This global fall has not yet affected India so much. We're kind of outperformers. What's your reading of the global risk-off? Does that continue? And can India stand out?
I think it's been a very interesting period, this particular most recent period of U.S. weakness and indeed European weakness, because emerging markets overall have actually held up much better during this period than they did earlier on in the fall, when U.S. market was weak in October and early November, and EM did very, very badly. So I think what's happening here is people are really focusing on it being more of a U.S. issue, and concern, of course, about the yield curve getting close to inverting, and concern about the economy next year. And that's exactly why I think there's a very good chance this might be the last Fed rate hike. And with the dollar holding pretty stable, on some sort of a trend, and there having been a lot of selling already in emerging markets this year, I think this is the reason why EM's not strong, but it's held up relatively well. And India, I think, is a good example of a defensive market in this sort of environment, unless you get a very big slowdown in the Indian economy itself, which doesn't, frankly, look very likely at this point.
Oh, yes. In fact, you know, I mean, I think 2018 is the year that emerging market investors would like to forget, right? I mean, the EM index, the MSCI EM index is down 15% for the year. What's your initial guesstimate? How do you think the start to 2019 may shape up for the MSCI EM index?
I think we'll rally. I think we'll go up probably around the 10% level. I mean, the way I look at the whole picture right now is that the global economy is slowing. I think that is getting itself priced into markets now. The U.S. economy is going to slow, I think, pretty sharply next year as the tax cuts roll off, and because the Fed rate hikes have already slowed the economy down, are going to continue to slow it down. But it's probably unlikely we're going to have a full-scale recession. And given that, I think a slowdown in the U.S. economy without there being a recession is going to give you a weaker dollar ultimately. It's going to keep the cost of capital down in terms of the bond yields. And I think that's what's going to pull money back towards the emerging markets. Now, having said that, it's going to be a nervous time because the global economy will be weaker. But I think the asset class is very cheap now, and I would expect to see a nice rally, maybe high single digits, 10% at most, dependent really on how bad the global slowdown becomes. I don't think there'll be a recession, but obviously that's one of the risks for 2019. This
high single digit is for emerging markets, you think?
Yes, that's right. High single digits for emerging markets in dollar terms. And I think that, you know, if you say to me what's the risk to that call, upwards or downwards, I think we may very well get more than that because, as I say, you've had a very big sell-off. Of course, earnings numbers have come down, but the markets are still quite cheap. And if that scenario I've laid out there in terms of the global economy and low bond yields play out with a lower dollar, you know, there could be an upside surprise to that sort of a call.
Okay, Jeff, well, on that optimistic note, we'll let you go. Merry Christmas and wish you a very happy New Year in case we don't speak with you before the year comes to an end. That is Jeff Dennis speaking about a 10% rally, expecting a 10% rally in emerging markets this year. But here are some more expectations on what the Fed might do this time around.
There's a very strong desire in the market recognizing the weakness that's developed as liquidity is pulled out of the system, that the Fed needs to slow down the pace. So it isn't so much their comments, it's really the reality underneath that says the Fed really needs to ease up, slow down, and not make the next step that they want in raising rates. Probably 2 raises next year would be a better target for the Fed, but also the pace at which they allow their huge balance sheet to run off. As they let that run off, that is really sucking liquidity out of the market. And I think that's why you're seeing decelerating growth, why you're seeing rates move up away from treasuries, and why you're seeing signs that there's a little fragility in the financial markets pretty much around the world.
If you look at the market sentiment since really the start of the year, where they were concerned about inflation, now they're concerned about downside risk to growth, it's very typical of market sentiment, of behavior, emotion, where they swing from one extreme to the other. But at the same time, if you look at the macroeconomic data, it's still telling us that the economy is in reasonably good shape, and the risk is actually more towards inflation in the short term rather than the other side. But obviously, I think this particular meeting is very critical to give us a picture or a sense of how does the Fed view financial indicators, because we have seen the stock market correct, we have seen credit spread widen to some extent, and whether the Fed will now be following these financial indicators more than it used to be, I think this is the interesting observing point for this particular Fed meeting.
Okay, that's the expectations from the Fed meeting. But for now, let's take a quick break. Before we do that, here's a quick reminder. The top team of JP Morgan will be joining us from 10 a.m. to decode the impact of the farm loan waiver, the inflation trajectory, fund flows, and of course, how to approach the markets in 2019. Do stay tuned in for this one. We'll take a quick break on that note. On the other side, our list of top 10 stocks is lined up.